ICICI ETF and CNBC TV18 present Smartly Passive, unlocking the world of ETFs.
Hello and welcome to CNBC TV18 and ICICI ETF presents Smartly Passive, unlocking the world of ETFs. This is a masterclass that delves deep into the concept of passive investing. So let's cut through the clutter and demystify passive investments with insights from industry experts and then learn how this strategy can empower you to achieve your financial goals. In today's episode, let's understand the various types of passive investments and how they differ from one another. And to understand that, we have with us two guests and experts joining us. Tarun Birani, founder and CEO of TBNG Capital Advisors, and Deepak Shenoy, CEO at Capital Mind. Gentlemen, thank you so much for joining us today on the show. You know, passive investments, they have been taking the investment world by storm globally, and we've seen that shift in India as well, though it's picking up slowly. What's your take on this?
Yeah, so thank you for having me here. And I think it's a very, very important topic. And as we are observing, this is a shift happening across the globe, and India is surely catching up on the passive side of it. As we talk, there is almost like $12 trillion of assets in the passive side across the globe in the ETF assets. Largely from 2004, this has grown from 2 trillion to 12 trillion, right? So this is like a large increase in the AUMs in the passive, which again comes from the simplicity, lower cost structure, efficiency in building asset allocation while looking at ETF structure. So which gives huge advantage to passive, and India surely has caught up with this trend which is there across the globe.
Let's now get in Deepak Shenoy in the conversation. Deepak, thank you so much for joining in. What are you making of the entire landscape when it comes to Indian markets and some of the products, how one can look ahead and diversify in terms of passive investment and ETFs as well, of course, there?
Passive is a very interesting institutional product, right? So because if you look at people in, let's say, an institution like an EPFO, if an EPFO wants to get into stocks, it either has to hire people to manage that stock portfolio for it, or it can just say, listen, I don't know what's best. I'll just follow an index, a broad index like a Nifty 50 or a Nifty 500, or a kind of index that will kind of match my expectations. It's great for institutional investing because you don't have to make too many choices. You know, you don't have to hire a full-fledged manager for yourself. You can, for a very low fee, get access to the market returns.
Let me come to you, Tarun. Take us through the different types of passive investing that we've seen, and how do they differ from active investing? What are some of the products that one can look at?
Sure. So passive investing, majorly there are 5 different styles of passive investing, starting with ETF. ETF is nothing but a structure available in a stock market format. I'll go as simple as possible. So you need to have a brokerage account to operate a ETF. The advantages of ETF is one can do intraday buying and selling like stocks in the same. Again, from a cost structure point of view, they are much cheaper compared to index funds. But again, the disadvantage of that is limited to index performance and potential we have seen that trading fees or the brokerage fees could be higher and all those things. Another, index funds are something which, like a simple mutual fund format, are available for investors. And the best part about it, about the same, is it replicates the index in a better way compared to the other formats. And index funds are, like, due to the simplicity of mutual fund and all that available, investors find is much more suitable. Again, there are concepts like direct investing, which again has not caught up in India, but globally it is a concept due to the tax harvesting advantage, where replication into of those direct stocks are available in the index. One can do in that, and investors can get the benefit of tax harvesting. And the last part is the smart beta funds. Smart beta funds are works on a concept on factors, and these factors are something which based on one's risk appetite, one can select whether you are an aggressive investor, defensive investor. The benefit of smart beta is with all the benefits of passive, you can get the advantages of active, right? The specific, let's say you want momentum, you can take a momentum kind of strategy. If you want low volatility, you can take a low volatility. So I think with this bouquet of different types of passive, the investor needs can be effectively taken care of.
In terms of liquidity in trading, if we talk about ETFs versus, say, index funds, how do they differ? What are these differences that can actually impact an investor's choice when it comes to investing in these two categories?
Yeah, so in terms of liquidity, the ETFs are available on an intraday basis. One can freely trade like stocks and the liquidity is available instantly. But one caveat, I think the indexes are as liquid or not. I think that is one question investor need to check before getting into ETFs, because it's still a market which is evolving in India. So I think there are some ETFs which are not very liquid, due to which bid-ask spread could not be very, very efficient for them. At the same time, index, there's a once-a-day kind of liquidity option available to the investor, where the day-end NAV is applicable to the investor. So from that point of view, liquidity is fairly available to both the options. But yeah, ETF has an advantage where you have an instant liquidity which is available.
Okay. Yeah. And Deepak, let me come to you. If we talk about the cost structures of ETFs and index funds, how do they differ? If we talk about expense ratios in particular, are there any hidden costs or fees associated with either option that investors should be aware of?
So that's very interesting. So in fact, what happens is that if you have an index fund and you see the expense ratio is 0.06 or something like that, index fund, not an ETF, an index fund, it will trail the index between 0.25 and 0.75%. That means every year you lose 0.25 to 0.75% simply because of operating costs. The cost, some biggest cost over here will be STT, because for every buy and sell of a stock, even in an index, the stocks keep changing. Every buy and sell of a stock costs about 0.1% STT, both on buying and on selling, right? So you roughly pay that cost whenever the mutual fund's AUM increases, or when there's a redemption, or in fact, when there is a change in the index itself. So this cost adds up, and this adds up to, even if the mutual fund TER is only 0.06, your actual return will be less by 0.26, 0.27. This is not the case in the US, where if they charge 0.04, your return will be less by only 0.04%. So in India, you have to actually use something called a tracking difference. It is available on the AMFI website every day, to find out which mutual fund is effectively more efficient in terms of reducing this cost. And some of them, I mean, the minimum I've seen is 0.25% on a yearly basis on most of these funds. But in an ETF, the specific thing is you don't have STT. The mutual fund never directly buys or sells stock. Very little of it does. What it does is it works with market makers who buy the basket of the stocks in the index in the same weight that the index is, and gives that entire basket over to the ETF. That is the AMC, and then the AMC issues units, the trust unit issues units against that basket of stocks. So they take the basket of stocks as a off-market transfer, if you may, and then they get units in comparison. The market maker is the one who places the buys and the sells on the index, and therefore there will be a difference between the NAV, which is, by the way, released every 2 minutes by the mutual fund house. So you can see a real-time NAV on the website of the mutual fund house itself.
Gentlemen, it's a very interesting chat, but we have to get into a quick commercial break. We'll come back on the other side. We'll continue our discussion on ETFs and passive investing.
ICICI ETF and CNBC TV18 present Smartly Passive, unlocking the world of ETFs.
Welcome back. You're still tuned to CNBC TV18 and ICICI ETF presents Smartly Passive, unlocking the world of ETFs. We have Tarun, Birani and Deepak Shenoy joining us on the show back again. You know, Tarun, we were talking about the tax difference on ETFs between the US and India, or the tax efficiency that ETFs have over in mutual funds maybe. What are the key differences in terms of tax efficiency between ETFs and index funds in the country? What are the post-tax returns that look like in these two different categories? Is it very different? How do we compare it with normal active mutual funds?
So I don't think there is any tax arbitrage available between ETF and index funds from that point of view, because both of them have short-term capital gains of 20% and long-term capital gains are almost like 12.5%. And till 1.25 lakh annually, you can save. There is a exemption given by the government, right? So from that tax perspective, I don't think there is any difference from index and the ETF option. What is very critical, at least from a tax efficiency part, is this budget has brought in a lot of rationalization. We are observing across asset classes, there is a standardization of long-term capital gain tax which comes in, right? So the tax becomes a very secondary point now. What is more important is the investment option relevant and suitable for you, which I think to my mind is one of the very big thing which has happened in last 6 months. And investors are going to benefit hugely because of that, because now investors have much wider options available. They can select the investment much more freely than they could do it before.
Okay, very interesting. So there are more options,
Yes.
and more than tax, the other aspects are looking very good. Deepak, let me come to you. It's a basic question, but you know, still a lot of people are trying to understand when it comes to investing in index funds. How can one start investing in these funds? Do you go the direct way? Do you go through a mutual fund? What are the ways to start looking at this particular category?
If you go through a distributor or a bank, that tends to hurt your returns a lot more, because the regular, which is the distributed, which comes through a bank or a distributor, is about 0.75 to 1% expense ratios. The direct ones are much lower at 0.2 or 0.3% expense ratio. So the idea is, if you're 0.2% expense ratio, you're going to lag the index by 0.4%. If you're 1% expense ratio, then you're going to lag by 1.25, 1.3%. So you don't want to lose 1.3%. So if you know enough about this strategy, then you should go direct. Of course, if you don't know anything about it, then a distributor can help you lead you through this, and that's fair, because you're paying someone for their time, and that's what you're doing on that side. I would say approach it with one part, which is start with something like as simple as a Nifty 50 or a Nifty Next 50, which is effectively the top 100 index fund, which gives you broad market exposure. And then you will find that the unfortunate problem with mutual funds and in general in a lot of things in India is we have a lot of choice, and a lot of choice means lots of selection to be made. So now you will have about 150 or 200 ETFs to choose from. On the Nifty is one thing, of course, you're going to compare them based on their effective tracking difference. I don't care about the expense ratio as much, but I do look at the effective tracking difference between that fund and the underlying index. The second thing that you want to do is figure out what kind of other indexes you want to track. We have an actively managed momentum strategy in our PMS, but there is also a momentum index. So if you like momentum as a concept, you want to then put some money in a momentum based, say, index fund, or I mean, if you're not doing anything active on the momentum fund. So the momentum based index fund, there are a bunch of index funds, and now there's an index ETF also on that. Some of these are new, so they don't have 3-year, 4-year, 5-year performances for you to actually compare it with. But I think as they get more performance, you'll be able to calculate, look at their performance over a long time, look at their tracking differences over a long time, compare them to the broad index, and then make those selections. You'll probably want to build either a core portfolio, which is broad based, which is basically the large amount of large caps, some mid caps, some small caps, and then some factor oriented strategies as a satellite portfolio, which allows you to target momentum or quality or value.
Okay, all right, that's very interesting. And nothing sounds Greek. We have the two of you to explain all of that to our investors and the viewers as well. Quickly, if you can tell us, Tarun, what does diversification look like when you have ETFs and index funds in your portfolio? How much should that be as a part of your portfolio, if you can tell our viewers here?
Yeah, so I feel diversification as a concept is something you need to have different sectors, different stocks in your portfolio, right? Which are genuinely non-overlapping, right? I think that is according to me is the big part of the diversification, which unfortunately as we talk, I have seen investor's portfolio is big with the similar kind of funds. There are 20, 30, 40 funds available in the portfolio. So diversification to my mind is very critical, and with indexing and concept and passive concept becoming much and much wider now, I think one can do this diversification in a much more meaningful way, right? Like you are interested in building a satellite portion on the IT sector because you find the valuation cheaper there. So that diversification can be easily done by building up a IT index in the portfolio.
There's one question for both of you. Let me start with Deepak. This is the last question that we have on the show. Just need your pro tip, success mantra while investing in passive funds, something that you can tell our viewers.
When you select an active fund, you have two problems, right? Ek to market girega, which is the market will fall down. And second is the manager will not do as well, or will select the wrong stocks, and that stock, the selection will fall down. You have two problems to think about. But if you choose the index fund, you're only worried about the market falling down. You're not worried because the index manager is going to be roughly close because you made those selections based on how closely they performed to the index in the past. So you want to select some of these funds. Now we have a PMS, but we actually have an index fund portfolio in the PMS where we buy ETFs. That has been a source of calmness for a lot of investors who particularly don't like aggressive investing. They're like, these other things you do are very nice, but I just want something that's peaceful. And while you can say that, okay, some returns have been better than the index and all that, so the index has not been bad. The last 5 years, a combination of Indian and US indexes, and you could actually buy US index ETFs in India.
Okay, that is very helpful, Deepak. Tarun, your take.
People, we are as advisors also, we do sometimes mistakes that we focus too much on individual schemes and managers. I think focus is largely on asset allocation. An investor with a high risk ability, if he is into defensive portfolio, I think the asset allocation is not managed correctly. And I have seen portfolios with huge property investment, huge debt investment, fixed income investment, unlisted investments, largely because the asset allocation is not done properly, and due to which the entire huge potential of the portfolio is not unleashed. Rather than that, the focus keeps shifting in these technical terms, and which according to, and it pains me whenever I see the client's portfolio, the larger focus, and we try to confuse them further. I think why don't we make it very simple? We create structure which can help them achieve their financial goals. A 15% compounding means every 5 years you can double your money, right? And Indian markets have been doing that in the past. And for next 20 years, 2 decades, if we are so positive about the market, I feel the broad-based index, which follow the principle of efficient market hypothesis, that Mr. Market is right, Mr. Market is right. Why don't buy the market? Buy the market largely and focus on asset allocation in a better way. Okay. What happens when you try to overtime the market, selection purpose, your mind get distracted, and due to which your larger objective of creating these wealth creation doesn't happen. And I have seen most of the Indian investors have missed that rally because they were overtly focused on timing the market, overtly focused on selection of the manager, rather than that picking up the right index in their portfolio with a core and satellite approach would have done the trick for them. And my suggestion strongly would be to focus this part in next 10 years to build up a stronger, simple portfolio with 5 and 6 strategies at max, not more than that.
All right, Deepak and Tarun, such a pleasure speaking to the two of you. Thank you so much for joining us today. It's definitely a masterclass on passive funds, and we've been talking about the benefits on the show: long-term growth, cost effectiveness, ease of access, risk management, simplicity, transparency. So it was important to understand these crucial aspects and how to select these funds that align with any individual's investment goals. So the mantra from both the guests was very helpful. So thank you so much for joining us today on the show. That's all from us, but stay tuned for more masterclasses which are coming up.
ICICI ETF and CNBC TV18 present Smartly Passive, unlocking the world of ETFs.